and we talk about it. Yeah.
Oh, okay. Right. So by the way, do you also analyze the crypto market?
I'm not really into crypto,
Right.
but I had a little bit of experience and exposure in crypto lah. So not the NFT side,
Okay.
but I observed the NFT side. But in terms of crypto coins, trading, I do a little bit. In terms of like recent, not so recent anymore. There's this like very popular crypto game where people can play to earn.
Yes.
I spent a bit of money in there as well.
Oh, okay,
But I went in understanding that there is definitely high risk involved because this crypto sphere is still very new.
Yes. Looks like having some corrections also. Yeah.
Yeah, so
Right.
the future is quite uncertain in terms of like a lot of people say it's gonna be there. I agree to that, but how long it takes, we still don't really have an answer to that.
Yeah, agree. So if someone is totally new to the financial part, whether investing or trading, and crypto could be considered one of the investment, yes, virtual currency, but they may want to start off not from jumping into crypto, I suppose.
Yeah.
Because it seems to be a little bit even more higher level. Even the liquidity not really there.
True, yes.
Yeah.
Yeah.
So perhaps you could even start from the more
Conventional
conventional,
markets,
yes,
yeah.
that's the key word. Yeah, okay.
Because they have been there many years.
Yes.
I would say more stabilized. Like they won't collapse suddenly lah.
True. It's evolving lah. This fiat currency is definitely evolving.
Yeah,
And whether how fast or how soon they're going to embrace also this the virtual currency still on the correction, and then if we jump in during the correction part, it's too challenging.
Correct.
Yeah.
It's very volatile, and you run a lot of risk of not just the market pricing, but I think you run a lot of risk in terms of like the platforms, whether they're stable or not, companies involved in it. Because it's so new, there's no proper regulation, no guidelines now.
Oh yes, correct.
So a lot of all this unknown risks that we probably don't have a control in it.
True, agree. So take note of that, guys. Yeah. One more question perhaps on the, USD has been strengthening against, major currencies, and if we are in a country that we need to buy a lot of things online nowadays, and a lot of people just price it in USD.
Yeah.
And if our country is currency is not really, back to USD or whatever, or we're even spending more money because of the exchange rate. So one thing is that, what's your take? Like, yes, the USD keep going up against the major, and is there a way to like hedge a bit of this currency risk thing? Or maybe it's just do trading also.
My personal view here is that, from a fundamental understanding, the dollar has been strengthening because the Federal Reserve has been hiking rate very aggressively. So my point of view here, based on some statistic, historical data, it does suggest that the interest rate hike from the Fed is likely going to be topping only when the Fed funds rate matches the inflation rate.
Wow.
So to give you an idea, like right now we're talking about 8% inflation and about like 3%-ish interest rate, right? So that's still that about 5% plus gap.
Okay.
So we don't foresee that the Fed funds rate are going to stop hiking in the near term, right? So maybe if the interest rate continue to hike in until about 5%, and the inflation rate starts to drop to 5%. Maybe when these two matches, then historically it does suggest that that's the tip of interest rate.
Okay.
So that can give you an guideline, an idea like how much more interest rate can hike, can go up, right? And from a fundamental point of view, then that also means the dollar has more room to continue higher if relative to that. But at the same time, we are in this very unique situation where the economy is actually not doing well.
Yeah.
Because inflation is not really because of high demand per se, but it's really because of crisis like energy, then suddenly everything spike up. So we are in a very unique stage where once this inflation has been brought down, we'll then very quickly transit into potentially a recession.
That's right.
And when that happens, the Fed again might be in a panic mode, and very quickly they might need to bring it down back the interest rate down very, very low to get it out from in recession.
Okay.
So we are in this unique environment where while we are looking at dollar strength, right, we also need to be very prepared that when suddenly this tip over, the dollar can collapse quite fast. Collapse not go to zero, but the drop back can actually happen quite quick. So this is something that it's not where you just buy dollar and then you stall it for 5 years. And then thinking you're definitely gonna make money from it.
Right.
So that's why I say again, it's a very unique. In my view here, we're in a very unique situation where buying and holding the dollar may not be very effective.
Right. Okay.
But near term, there's definitely more upside. So that's where the beauty of I think trading comes in as well, because you're more of a short term. You're more
right.
On the ball with the market. So you make decisions based on what you're also seeing from the market. Whereas investing is more of a long run, right? But,
Yes.
to be honest, we don't invest in currencies.
Yeah.
You rather invest in stocks, right?
Yes.
Yeah. So I think in view of like dollar related, then trading would naturally become one of the alternatives. Yeah. But to hedge against inflation, we are again in a very unique environment. Usually people say when inflation is high, gold will rise, but you look at this year, it doesn't do that. So we are, as I mentioned, we are not in a very conventional environment today. Yeah. So if you need to adapt again as a trader, adapt. Right? So you can't conventionally that's how it goes, then I just follow.
Yeah. The past, the history really do not reflect the future.
Yeah, it gives you a framework, a reference,
right.
but you don't want to just follow blindly.
So it's like the conventional traders, or maybe not conventional traders who are in the back then prior to COVID. I suppose that they have to really evolve with the market and with the time. It seems like getting a little bit unpredictable. It's like haywire, the fundamentals don't really project the kind of the outlook as expected, right? Yeah, correct. So what is the best thing, the tip that you want to share with us? Like, wow, it's like I don't know. It's like are we quite lost? What should we do then now? Still keep some more cash rather than just whatever is not even bottom yet. For us to really do some investing and right, and then but perhaps explore into trading, which we could also continue to be aware of the market situation, because that volatility does help us, a little bit. It's just that we need to know how much capital to set aside. Yeah. And it's like, what is the objective now for us to even, go into trading? Because it's like really to trade for a living, or to trade for a hobby, or to trade to be aware of the financial situation before we explore into investing.
I would say now, if let's say someone who is choosing one avenue, whether is it trading or investing, to focus and start off, at this current stage, I would more inclined to suggest that person to be looking into investing. The reason is because we know equities are dropping, we know interest rates are hiking, and based on a macro understanding from the equities market, as interest rate continue to hike, to increase, the equities market are going to continue to drop. But as I mentioned just now, there's a good chance that once we hit a certain peak on interest rate, it's going to be falling quite aggressively to recover the economy from potential recession. That is where the stock market can actually recover very sharply. And again, if you put the perspective of a bear market in the equities, we don't get it a lot. So historically, every 20 years we get about maybe 4 bear markets. Each bear market, statistically again, each bear market lasts around 10 months. So while 2020 has been falling, we don't count the bear market at January, because a bear market technically starts at when the market drops 20% from its peak. So rough estimate is actually around June, July, which is the start of a bear market, because that's where we get a 20% drop. So if you calculate 10 months, it's actually towards like maybe next year, June, mid-year, right? And again, these are guidelines. It doesn't mean that, oh, next year, June, the market is going to rally.
Sure.
And then you put that in just now, my perspective of how interest rate is probably going to hit maybe about 5+%. And looking at the pace of how the Fed is hiking, it's about like 75 basis point or even half a basis point. Sometimes they were talking about up to 1%. So if you look at the pace and how fast and where we are and potentially the peak of the interest rate, there's a good chance we might also have this confluence where 10 months into the bear market and then the interest rate seems to be at peak. So when all these are aligned, then obviously we have a high probability, but doesn't mean it's 100%. So we have this window of period where we can still catch like good stocks at a very, very cheap price. And when it bounces, you can actually really capitalize on that.
Okay.
Why I actually say investing is really because of this, where you don't get such situation and environment, or I would say opportunity every year. But trading is something that, to be honest, if you have that skill set and the ability to trade the market, every year you can do it. So it's also a strength of trading. It's not like you don't do trading, right? It's just that if today you're very new and you don't have the capacity to do both, right? Then you might want to look at this first, because this is where the opportunity is not every year and we have it now. So you might want to focus on that. But trading is something that it really doesn't matter what's happening. You have the ability to do it almost every day, every year. Yeah, so that's the unique strength of trading. I mean, don't not do trading. So still do trading. If you have the capacity, that's where both comes in very handy. Yeah.
Sure. Just that investing, the way you put it, that means we have to go like a dollar cost averaging method. Right?
So yeah, I mean, you if you start now and you just want to do dollar cost right now, you can do it. But of course, there are also some techniques in investing in equity markets where you try and catch the bottom. That's what they say. You try. Obviously, you don't need to do it.
Time the market.
You don't need to do it also. But there are certain metrics and again guidelines to help us do that. Like one of the simplest metric that I'm looking at is the S&P mean. So you take like all the way from the S&P where it got started with data on it, and then to today you plot the mean. You start to realize that obviously mean means average, right? So you realize that the price of S&P tends to like overextend above the mean, coming down below the mean, but eventually it's always going up based on S&P or in fact Nasdaq and Dow Jones as well, because of monetary system, how we're running right now. It's always up. Then you realize that you can actually use this to also help you time your investment a little bit better. And I always share, recently I shared that a lot of people are already panicking when the S&P drop. But if you have certain frameworks to guide your perspective of the market, you won't be in fear, because if you take a look at the mean right now in S&P, we are actually not below the mean. So a lot of people are already panicking, but if you look at the long, big picture, we are back at the average. So it's a very typical thing that happened since the S&P started, where we have data on it. So there's no need to panic, because that is just the average of where it is, because last 2 years was so easy. And it was like straight up. Whenever you buy, you make money. And everyone just got relaxed, like they totally forgotten about market can still come back down. So we can say like last 2 years the market is actually overextended and it's just averaging right now.
Right.
So you can use that a little bit to help time the market a bit. When it continues to drop and it starts to go below the mean, maybe that's the better time to get involved in more aggressively.
Right. Okay. Sounds good. It seems like we have quite a fair bit to learn from you still. Yeah. Okay. But we'll probably check out on the next round for more of how we can probably learn from you. I think that'll be good. On the investing or the trading aspect. Okay. That's good. Thank you so much, Kar Yong, for sharing quite a fair bit of insights and tips, and whether we are supposed to look at investing or trading, or let's go into both also. The best part is that. But of course, I think to wrap up, also Kar Yong mentioned that the community right, that you're with, because it will be very challenging for one person, you know, that whether you do investing or do trading, and we always want to mirror, you know, certain giants that we can resonate with, and to have a coach even, because sometimes on hindsight we can't even see ourselves clearly, right? So we need somebody else to highlight to us and see on hindsight, and or have a second opinion, right? So this is where you guys will know, you know, if you are quite drawn to Kar Yong's approach of looking into the market. I think top-down approach is really good, right? For us to really then go into the targeted aspect to decide on the investing part or the trading aspect, right? Okay, sounds good. Hope we will have you on board, you know, to share on the next part a little bit more particular, how we can perhaps stack on your system, because it sounds like you do have a system to check whether, especially whether the investing part or the trading part, you know, that we can further mirror to have a guide, you know, for us to further our this, you know, financial aspect. Yeah. Okay.
Can.
Yeah. Okay. Thank you so much, Kar Yong, for coming on
Thank you.
to our channel. Thank you, guys. See you next time.